Hi again, this is Craig, the options linebacker. This is the weekend report for Sunday, August 29th. We'll start out today with a monthly chart of the S&P 500. By all rights, last week we should have seen the beginning of a big drop on the S&P 500. We've gone from a higher high to a lower low. We've clearly put in a lower high on the monthly chart, and as we'll see in a minute, the fractal components in the market appear to be unfolding to the downsides. As we look at the weekly chart of the S&P 500, it's double topped, and again, lower high here, starting to work its way lower. And as we move down in time frame to the daily chart has broken out of an ascending wedge pattern. This is normally bearish. Big red candle to the downside, and even the daily chart had put in a lower high as of last week. What we should have seen is all these dominoes should have been kind of combining together to start this chain reaction to the downside. But that's not quite what happened, is it? Going back to the daily chart of the S&P, we can see that the real battle is down here at around the S&P 1040 area. This is where the real support has been found. In fact, on Friday, what we saw was a lot of buying on weakness as the chart began to unfold right after Bernanke's announcement at 10 o'clock Eastern. The next 10 minutes was a very, very strong sell-off, but every time that there was a waterfall decline, there was a strong buy program waiting to accept those shares. Now, something that I noticed and pointed out in the premium newsletter this week was that every time we had a reversal type of candle, so if we go back to this candle here back in early February, beautiful hammer candlestick coming down after a big vicious down day. And normally a hammer candlestick is the beginning of, it can be a reversal candle. But of course, one candle alone does not make a reversal. So the next day was actually a fairly bearish candlestick on here, closing much lower than the body and leading everybody to believe that, well, okay, so that was just a fake out. That hammer candlestick was no good. This thing is still going lower. Well, that got reversed with a strong rally to the upside. Again, if we continue to look at these, every time we had a strong hammer candlestick off of the bottom, and again, this one was in late May. The next day was a very bearish candlestick. In fact, almost a shooting star type of candlestick with a price went much higher and then by the end of the day closed near the lows. Very, very bearish, very deflating to the bulls that thought that they had a bounce off the bottom. And then the next day, boom, back up again. Okay, another fake out. All right, same thing happened back in early June. Not a definition of a hammer, but it's still a nice tail on that candlestick, and it closed near the highs of the day. The next day went much higher than that and closed near the lows of the day. Again, very, very deflating to the bulls, getting everybody to give up and saying, oh, this thing is just never going to go higher. And look what happened right after that. Okay? Same thing happened in early July. Nice hammer candlestick. The next day, very bearish. Rally right after that. So what do you think we saw this week? Well, this week we saw a couple of these types of candlesticks where we had a bullish divergent bar. We had much lower prices during the day and then a close above the prior day's close. So that's a bullish divergent candlestick. Then what do we have on Thursday? Again, another one of those bummer days where the price goes higher and then it just gets closed down near the lows of the day, lower than the previous day. Again, another bummer, and everybody gives up on the market saying it's going much lower, and then look what happens on Friday. Big day to the upside, decent volume, nice tail down, another bullish divergent candlestick. So we've seen this exact candlestick pattern 1, 2, 3, 4, we'll count this one up here, 5 times, now 6 times this year alone. And every time that we've seen this, we've seen anywhere from a colossal rally to at least a very modest rally coming up off of here. Whether or not it's in the same wave or not, still it has led to higher prices coming along off that pattern. I believe the fundamental reason for the higher prices after this is because that fake out day, that bearish fake out day, encourages too many bears to go short at the bottom of a move, and they're wrong. They have weak hand positions. They don't have any embedded profits into there. So on any subsequent rally, they are scrambling to get out and short covering, and that does produce the rally. But you have to keep in mind, calling this a bottom is, again, just like trying to catch a falling knife, because right now the daily chart is in a pattern of lower highs and lower lows and is still in a primary downtrend right now as measured by this channel. So a couple of things have got to happen for this chart to reverse here and start to work higher. First of all, obviously we need to fill the gap at this level and then continue higher. We need to break out above this channel and then start to put in, and this is going to be scary because what's going to happen next is that you're going to see a higher low. What would be better than that is actually for this to take out the prior swing high at 1100. I think it's unlikely to do that. I think what's going to happen first is it pop up above this channel and then put in a higher low, much like what happened here off of this bottom. This did not take out the prior swing high at 1130. The first thing it did was create a higher low, and then it started to work on that higher high. In fact, it never did get above there. So I think the same thing will have to happen if this chart is going to start to work higher from here. The first thing will happen is it'll pop up and appear to lose velocity and then create that higher low. Again, this is where it creates too many bears jumping on way too late in the pattern, and then they get reversed. To really how rallies get started. Now, the other possibility that we might see, and we have to keep our minds open to this, is that the price is going to come up here, fill this gap in the futures, and then just keep on working lower from here. It's not going to take much to get this chart to roll over and go back down and retest S&P 1010 again. What I'm trying to do is to think like a contrarian. A contrarian is going to go against the herd. Right now, all of the herd is bearish. Right now, everybody is out there thinking that prices are going to be going down to S&P 800s and 900s. And if we think against the grain here, against the crowd, we might look for opportunities for a quick little rally, even if it doesn't come up here above 1130. What we can afford to do in this market is to go about 1 week at a time. Now for the October cycle, which we started last week, I've got a great bull put spread down here way out of the money, which I got on the VIX spike down here into support. And what we're looking for is potentially, again, that little bounce to come back up here so that I can get a nice distant call spread before the implied volatility starts to really collapse on any subsequent rally. If we don't get that rally, again, if it fails, that's up here, and then what my job is to do is to get a call spread, perhaps going to be a little closer up here, but regardless, get a call spread in play for the month of October. And then I've got the full condor on, and we can just sit back and just manage it defensively. We also play low probability iron condors in the newsletter. What's good about them is that we are risking to the downside what we were looking to make on the upside. So it is a much tighter iron condor, but if we use our active defensive measures on here and look to take decent profits when the market allows us to do so. So in other words, if we do see a little bit of a bounce up here, we're going to be right in the middle of the sweet spot as measured by the white line on here, and look to take a 25% return on risk for this trade for the month. So 25% return on risk. If that's not good enough for you, I don't know what is. And lastly, because of the fact that the market is just flying around the place, we're trying to take advantage of this with swing trades. We have this particular strategy, the 8 and 21 EMA, which is offering us some really nice signals over the last few months. We went short at this position here on the S&Ps and took half profits down at this level, so we're managing the last 50% of the position and just looking to make sure that it stays below this blue line, which is a 21 period moving average. As long as it stays below there, we stay in the position. So that's it for this weekend, folks. Take care and watch out for the light volume this week. Enjoy that nice long holiday weekend next weekend. See you soon.